So the last, I would say, several years, the GP-led side has been the dominant feature. And that goes back really to 2019. That was the first year that we saw the GP-led market eclipse that of the LP-led market. Last year, 75% of the transactions were GP-led. So what we saw, I would say, last year and really the last couple of years were some of the living sector transactions, surprisingly enough, not get done. We saw definitely, not only within our own books, but within valuations overall, year-end 2025 start to be that normalization on pricing, and that's when you can have some of those more constructive conversations going forward on recaps. So you've seen definitely capital flows continue to grow outside of North America. As a result, definitely seeing pipeline build across, I would say, UK, Western Europe, and Asia, and specific spots within Asia too. So I think more Japan, think more Australia, potentially Korea. So effectively a third of the distributions that you would expect in a normalized environment, that's what's coming back to LPs.
Hi everyone, thank you for tuning in to another episode of Women of Secondaries, produced by Secondary Link and hosted by yours truly. My name is Kristina Kulikova. I'm the Senior VP of LP Advisory here at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the absolutely incredible powerhouse women driving this market and their expert views on the secondaries industry. If you missed our prior episodes, make sure to check them out on Secondary Link's video and podcast section, YouTube, Spotify, or catch short snippets of it on our LinkedIn page for Secondary Link. On this 13th episode, can't believe we're already in our 13th episode, I'm very privileged to have a chance to sit down with one of the most tenured senior professionals in the real estate secondary market, who has been spearheading secondary real estate deals globally for over 2 decades, at one of the biggest firms in the market, Ares Management Corporation. I'm of course speaking about none other than the partner and co-head of the Real Estate Secondaries team at Ares Secondaries Group, Michelle Creed. Welcome, Michelle.
Thank you for having me. Really excited, Kristina.
Me too. It's an absolutely timely time to be talking about real estate, I think. And just before we get started, just to give perspective to our audience, and I'm sure that very few people who are not familiar with Ares Management, but Ares is of course a leading global alternative investment management firm offering clients complementary primary and secondary investment solutions across broadly credit, real estate, private equity, and infrastructure asset classes. And I believe as of December 31st, feel free to correct me if I'm wrong, Michelle, but Ares Management Corporation global platform had over $622 billion of assets under management, with operations across North America, South America, Europe, Asia Pacific, and the Middle East. Hope I got all of that right.
You did. Well done.
Thank you. Well, Michelle, currently, in addition to being co-head, you also sit on the Ares Secondaries Group Real Estate Investment Committee, and have had an absolutely impressive career that spans now over 20 years. So I feel incredibly lucky to have a chance to sit down with you today. But let's roll back the clock. How did you get into secondaries, almost 23 years ago in the first place?
Sure. No, happy to take that. It wasn't as if I started out seeking real estate secondaries, and candidly, that's because it was a really small industry when I started out. There was really only a few groups doing what we do, but I was an economics major, and I was actually a studio art minor. So 2 different sides of the spectrum, but was definitely leaning towards the econ and finance side of things. And with that, really started to look for what the options were at smaller groups, thinking that if I joined something that was still pretty nascent in a niche industry, there could be a way to really learn, get your hands dirty pretty quickly. That panned out in the end, but that was really the impetus of it, looking for a smaller group in a niche industry.
And at the time, I guess just, to think that Ares was a small group, it just tells you how far the market has come, right? And how far the industry has come. Quickly, before we get into sort of meat and potatoes, how would you describe the secondary market in 3 words, the real estate secondary market specifically?
Well, I guess I've used one of the words already, so I would say niche. It still really does continue to be a niche. I would say we push boundaries, so innovative would be the second word I would use, and then growing. it is still continuing to grow today. So still definitely in the early stages.
And we'll get into a lot of the innovative component about it for sure, right? Because I do agree there's a lot to be unpacked there. Well, as we mentioned, you're working at one of the largest firms who, by the way, hot off the press, have just been announced as the top real estate secondary buyer of 2025 in the Secondary Link's annual Secondary Market Awards, which, as I was reading through the categories, they recognize the leading secondary buyers across real estate. They note scale, pricing discipline, consistent execution across real estate transactions. And I think there was something like over 3,000 professionals voting. And so this is a huge win for your team. Congratulations.
Thank you. No, we're definitely proud of it and really excited about that award overall. So appreciate it. Thank you for the support.
Yeah, particularly the consistent part of it, right? It's like you can see one or two deals come across the finish line, but when it's an ongoing, consistent success, it's amazing. So let's get into the nitty-gritty. You guys recently published a report noting that real estate secondary market volume hit a record of something like, was it 20.3 billion in 2025, yep. I believe, right? I'd love to take a little bit of a deeper dive in that. Maybe to set the stage from your seat, how would you characterize the overall state of the secondary market in real estate in 2025 and then, going into 2026 compared to the last few years or COVID years and just coming off of that?
Sure. So definitely global and growing. You're right to say 20.3 billion. So 2025, it was really a banner year for the industry. That is the high water mark to date, although we do think looking forward, we're going to surpass that. When I say it was global in nature, so there was a mix from both US and Europe and Asia being on the expansion side of things, 59% on the US side specifically. But the mix there, it's really important to think about the GP and the LP side of the market. So the last, I would say, several years, the GP-led side has been the dominant feature. And that goes back really to 2019. That was the first year that we saw the GP-led market eclipse that of the LP-led market. And last year was no different. So the last few years, it's been about 2/3 of the market. Last year, 75% of the transactions were GP-led. So it really speaks to the fact that there has been a dominance overall in that side of the market. If you looked at it on the continuum, though, over 2025, Kristina, what you would see is that LP-led transaction volume did start to pick up in the second half of the year. And we saw that there is some seasonality, as you know, with secondaries, where quarter end and certainly year end, you see the pickup. But we definitely started to see that not only in closed transactions, but actually in the overall pipeline in terms of there being a shift where LP side started to pick up, which we think is a positive and really a sign of where the market is today.
That's interesting because, and I'll dive into the GP-leds in a second because that's a really big and important topic to cover. But in terms of both LP and GP, were there any strategies that sort of you saw notable differences around, whether it's, core plus, value add, or maybe particular sectors, like whether it be logistics, data center, et cetera? What drove majority of the growth?
Yeah, I would say, so quality above all. I think with there being such a small buyer set, it still maintains to be a buyer's market as it relates to real estate secondaries. And so when a group is thinking of selling, whether they're an LP or a GP, they're really looking to transact in the secondary market because something's happening to them. And so they're looking to successfully complete a transaction. So on the LP side, that often means that you're seeing groups bring not only quality funds, but sectors that people want to buy. And so it becomes more of a, is it industrial? Is it the living sectors? Is it data, digital, cold storage? Those were themes that we certainly gravitated to as a buyer, and I think other buyers as well. And so as a result, you started to see a shift towards those sectors, those in favor sectors. And then similarly so with the GP side as well. I would say the living sectors, industrial being a big proponent there of the overall transaction volume.
Were there any sectors that maybe you saw in your pipeline that didn't ultimately materialize as deals and something that, you could speak to the broader market of, maybe a certain out of favor sector that you keep seeing over and over again and it's just tough to get deals done in that sector?
Yeah, so office is the one I think that folks would point to as an obvious one, but there was less office that was actually brought to the market. We saw really right after the interest rate spike, office brought to market, and this was really, okay, we didn't do it during the pandemic, now's the time to do it. That didn't really mean that those sales converted into closed sales. And so what we saw, I would say, last year and really the last couple of years were some of the living sector transactions, surprisingly enough, not get done. And so you saw after the interest rate spike, good, stable assets, but just a capitalization mismatch. And as a result, those owner operators or sponsors were really hoping for a bit of aspirational pricing, I'll say. And so as a result, didn't actually end up transacting, mostly in the recapitalization space. Those transactions are definitely coming back to the pipeline today. So that's, I think, where we're seeing that merry-go-round come back is on the living side. Mostly multifamily. I would say student housing, if you think about the adjacent sectors. Student housing did start to get done because there was a reset there. Fundamentals were strong and the actual capitalization made sense. When you think about some of the other adjacent sectors, manufactured housing, even seniors, those are newer entrants, I would say, into the pipeline today.
And do you think that those have a higher likelihood of getting done this year versus last year?
I do think so. I think 2026, you will see more living get done than you did last year or even the year before.
Why do you think that is?
I think there's going to be that reset of pricing from the sponsors where they're understanding where the values are. We saw definitely not only within our own books, but within valuations overall, year-end 2025 start to be that normalization on pricing. And that's when you can have some of those more constructive conversations going forward on recaps.
Yeah, I think we see that on our side as the advisor as well. Now, it's interesting because Setter publishes our semi-annual volume report. And so when we did a full year and semi-annual, when we did it for the full year 2025, I think overall across all asset classes, right, GP-led volumes were something like 44%, maybe tethering closer to half for some other advisory reports as well. And clearly, it's a meaningful difference in the real estate side, right, where you see a lot more GP-leds being done in real estate. Why do you think that is? Why is it specifically more GP-led than LP-led?
I think it gets back to where the discounts were for the LP-led side. If you look at the discounts for the other food groups across secondaries, they were pretty palatable. You were comparing to public markets, 2025, there was strength. You could underwrite those public comps. You were seeing single digit, if not low, double digit discounts. That has not been the case for real estate. Real estate has really had, and this is in the direct market, everything thrown at it possible in the last 5-6 years. And so as a result, the discounts have remained high. They've remained in that 30% range, plus or minus, over the last 4 years. And this is for closed transactions. So let alone the transactions that were priced at 40, 50, 60, 70% discounts. That definitely is a barrier, I would say, in terms of those LP trades getting done.
And do you see a difference in, well, pricing is, of course, there's a difference in pricing based on the geographic location of the assets, but anything you can point to where, majority of the deals that are actually able to come to fruition are, whether they're North American or European or Asian or any commentary there?
So we've definitely been active across all three regions, and I wouldn't say one automatically trumps the other in terms of path to close. There's certainly the look back. That's one of the things I think we have the luxury of, is being able to look, where do capital flows go over the last 5 to 10 years? That's likely going to be a pretty good indication as to what could trade in the secondary market. So you've seen definitely capital flows continue to grow outside of North America. As a result, definitely seeing pipeline build across, I would say, UK, Western Europe, and Asia, and specific spots within Asia too. So I think more Japan, think more Australia, potentially Korea. When you look at those amounts, I wouldn't say one is, again, path to close with more certainty, but you are seeing more non-US, non-North American than we had been seeing historically.
Interesting. And when it comes to the types of GP-led deals that are being done, but again, when we ran the survey, we saw, I think, 90% of GP-leds, again, across all asset classes, were essentially CB deals. Are you generally seeing that be the case for real estate GP-leds, or are there other types of deals such as GP replacements, GP strip sales, GP management company sales, anything that you can speak to on that front?
Yeah, so I would say one of the creative things within real estate secondaries is that it's definitely not just single asset CVs. And that's a function really of the duration of the investments that we're talking about. So even in the current environment, we're still reviewing and thinking through and having conversations with GPs about fund level continuation vehicles. So think of that more as your long dated fund that really looks long dated in terms of the vintage year because it was a 2018 vintage. So it's a 8-year-old fund. That used to sound old, 8-year-old. That would say, okay, wow, it's at the end of its natural life. It's into the extensions. But then you think about that fund for a minute and you realize that investment period started pre-COVID, likely went just into the heels of COVID. Then you have the pandemic where everything paused, probably from the business plan standpoint. Then you have the interest rate spike. And so when you start to break it down in that way, 8 years old is not that old anymore. And so those conversations are pretty meaningful because those GPs are holding assets that are not only high quality and performing, but they haven't had a chance to sell down everything in the book yet. And so they're saying, well, can I recapitalize a component of it? Maybe it's all of it through a full CV. Maybe it is a component of it. Maybe it's my living sector asset specifically, depending on the manager. So we're having those conversations. Also having conversations with groups that are really bridging the issue right now. There's two issues. So one, they're trying to get some DPI back. That's been, I would say, the motivation behind a lot of the LP and GP conversations today. Can we manufacture DPI through a secondary? That's pretty meaningful. But the other component is, if I'm not getting DPI back to my investors, how do I raise capital from them? And so we were speaking to one of our investors this morning, and the conundrum that they're finding themselves in is we haven't been able to get the distributions back that we thought we would. So finding commitments available for us in 2026 is tough. They're looking at their real estate allocation and trying to figure out how they can pull it together. And so one way, certainly, that a GP on the flip side of that can look at their book is to say, we could recapitalize a base of our existing portfolio with a secondary market buyer. And we can do that at a significant cut effectively in valuation relative to what they came in at. But at the same time, build some blind pool in, build some capital to bridge to that next successful fundraise. So that's been a conversation, I would say, that's very current and timely. And again, thinking about the GPs that are focused in the sectors that we like. So broadly speaking, you can think living being a key topic for us there in that component.
And this is just a side thought that I had. Are you seeing any pressure on GPs for fees and kind of resetting economics when they're doing either a CV vehicle or any type of recap at the fund level? Have you noticed that be a theme or sort of a point of negotiation?
It's always on the table. Alignment of interest certainly is a component of what we bring to the table because we can really start fresh with that clean slate. And so oftentimes it's not only the fees that they're willing to potentially cut, and you want to still have them aligned, certainly, with that go-forward business plan. So there is that tension there. But also, more importantly, how much skin do they have in the game? Are they putting in additional dollars into the new venture such that you feel as though they're going to have their eye on the ball that entire duration? And that the team that you want in place to see those assets through the entire duration sticks around.
Yeah. Yeah, because we've had a lot of, LPs sometimes that may be dissatisfied with the DPI that they've seen from this fund. And as you said, 2018 is a really interesting vintage because you do have that period of sort of lack of activity, of any kind of activity right out of COVID. And some of their commentary is, well, we'd like to sell this unless the manager cuts their fees on what they're charging, right, for the duration of the fund. And so then it's an interesting conversation to have with both sides. But actually, I'd love to hear your perspective since we're on the LP topic. What have you seen as the biggest reason for LP selling? You mentioned the lack of DPI and sort of needing that capital to fund new commitments. Anything else that you've seen as a driver of sales?
Yeah, so definitely the DPI remains in the current time frame to be the biggest piece. And just to put stats around that too for you, Kristina, specific to real estate. So if you think about the average fund over the last 10 plus years, typically in a given year, that fund on the real estate side, this value add and opportunistic fund specifically, will distribute 21% of NAV. So it gives you a sense of cash flow planning models. That's what investors are really banking on, so to speak. over the last several years, we haven't been close to 21%. We're actually at an all-time low within the last 12 months at 7%. So effectively a third of the distributions that you would expect in a normalized environment, that's what's coming back to LPs. And so when we say there's a lack of DPI, it truly is meaningful. It does not look like that within the other sectors. They're much better off. Even venture is actually in a better spot than real estate, which was somewhat surprising when our team looked at the materials. So that still remains, I would say, the most poignant and acute need today. But it still is very much an all-weather strategy. When we think about other liquidity needs, there continues to be shifts within CIOs. And so that often does bring about conversation as to how to reposition the portfolio, because they've inherited a portfolio that's not their sponsor list, that's not their group that they've historically maintained relationships and conviction with. They would like to really reset, and they have a window to do that. So that continues to be, I would say, a main driver on our pipeline. And then lastly, consolidations within larger organizations. You'll see just the multiple names in terms of line items for real estate funds, real estate exposures, or just the sheer volume. So one large group we're talking to, they just have so many lines. And the mandate from their board is simply, we have to just cut this number of lines. We can't contemplatively go to all of these AGMs. We can't speak to all these sponsors. We have to do this in a much more organized and systematic format going forward. Let's do a sale.
Yeah. Yeah, that resonates a lot with me and kind of what we see on our end as well. And back to sort of full circle of flight to quality, right? They want to support their core GPs. All the rest sort of will, not that they may not want to, but at this point they may not have a choice, right? But to kind of streamline that portfolio. So 100% agreed. And you mentioned in terms of, discounts that you're seeing in the market, and I would say 30% is probably from what we see on the advisor side is quite conservative. I think we've seen deeper discounts, right, where some as well into sort of 50, 60% discount territory to NAV, obviously depending on the strategy, region and sector and all that. But across all asset classes, we've seen about 32% of deals being done on a deferred payment basis, right? So not a cash on close type of structure. Curious specifically on real estate, if you have seen what the proportion is of cash deals versus deferred deals versus if there's any earnout components to deals when we're looking at more of CV. What has been the breakdown to sort of try to bridge that spread?
Yeah, so I would say they're probably, I would call it structure light transactions. There's been fewer of them in real estate of late relative to, say, what we saw out of the GFC and a little bit thereafter. That was definitely a go-to in terms of getting a deal done. You were close on discount, but you weren't quite there. You wanted to get to more of that normalized discount in real estate. That's really a high teens discount. In the current environment, we just haven't seen that. If the bid-ask spread is wide, doing a deferral doesn't likely get you there. The interest rate would just be too high, the implied or effective interest rate. And so I think you need a smaller bid-ask spread environment for those types of a structure to work. There's other structures more on the pref solution side that you can utilize to really bridge significant discounts. And that's tended to be where our team has focused in terms of providing creative solutions.
Got it. Makes sense. So pivoting to a little bit of the open-ended side of the market. So we have seen this last year working with a lot of open-ended real estate fund managers that are trying to solve for redemption queues, or they're trying to, alleviate their investors that are sitting in these redemption queues for quite some time and are obviously looking at options. Have you participated in that side of the market? And if so, has there been any alternate structures that have been employed for those types of deals versus the closed-ended fund deals?
Yeah, so it's definitely a market in which we can play. And I'd say those windows in time have been pretty short in terms of how long they're open. So we saw a little bit of that out of the GFC. We're now seeing that window open again, certainly as queues have built. We've been pretty thoughtful as to where we've spent time. And it really does get back to the sector selection as well as the asset selection in the underlying core fund itself. And so not just thinking about it at a high level, are you buying it at a discount and relieving some queue? Great. That's not going to check the box for us. So it's been, I would say, pretty low in terms of hit rate there for us. In terms of using structure, we haven't used structure for those transactions. So it's been more of a here's the discount, because oftentimes when those queues are building, it's a combination of some investors putting themselves in the queue to have the option because they want to understand what the option is over time. Great if they get some relief. And then the second component of it is if they do want out at set price, then they're willing to take it, but there's no real pressure to take that discount. They can just remain in the queue.
I'd 100% agree with that, because a lot of the times that we see investors putting in redemption requests are those that have very patient capital, right? And it's more, as you said, more option value to have on the table if needed, if and when needed. All right, well, let's switch gears a little bit and chat about fundraising, maybe broadly on the market. So according to your, I think it was Q4 25 earnings call, you recently launched your 10th Real Estate Secondaries Fund. Congrats. Generally, how would you compare fundraising momentum for real estate secondary strategies versus primary real estate strategies sort of across the market?
Sure. Yeah, we're definitely excited about the launch of the fund, so thank you for that. I would say in terms of the approach to fundraising, there's not that much distinction between primary versus secondary. You really are having conversations about real estate first and foremost, which is a key component to most of the people that are in the seats in terms of being decision makers at the organizations. We're talking to groups today that really are looking in some ways. I would say one point that is resonating as we have conversations are groups that have been a little bit quieter in terms of commitments that they've made over the last several years. And so they're recognizing that secondaries can be a way to really backfill some of the vintages that they missed out on over the last several years. So that's definitely an element that you wouldn't see in a primary conversation. I'd say the other component is, can you get that DPI to build more quickly? Because it's a secondary market fund and that J-curve mitigation that does exist naturally in terms of the behavior of the cash flows.
Yeah, that's kind of what I was thinking, is whether, the quicker expedited DPI might resonate with groups more, and so, might pull their dollars in more towards secondary strategies rather than sort of primary dollars. But I guess the jury's still out in terms of, statistically where we'll see more momentum. And are you seeing any interest from the retail space? Like obviously there's been a lot of, big rise in the evergreen 40 Act funds, some multi-strat, but a lot of them PE focused, some credit. Have you guys seen that momentum enter the real estate market as well?
So you're right to say definitely within private equity. We've seen that be a large piece, certainly on the private equity secondary side. We haven't in full force entered within the real estate business as of yet, definitely exploring, but there's different tax considerations to think through. So it's a different, I'd say, avenue to go through. I think it makes sense in terms of the thesis. So if we can find a structure that works, then I think it does make sense.
Well, looking ahead, right, the world as we see it today obviously has a heightened degree of volatility, geopolitically and otherwise. Maybe that's softly said, but as we look for the bulk of this year, what macro or sort of capital market factors do you think will matter most in order for us to continue to see the growth of the secondary real estate volume?
Yeah, so I think it comes back to certainly real estate fundamentals and thinking through capital flows on the direct side. As real estate underwriters, real estate practitioners within our business, if we can underwrite portfolios that have been seasoned over the last several years, so there's a predictable set of cash flows that we're underwriting, but then also, more importantly, a shorter duration, that predictable set of exits, that makes our job that much easier in terms of ultimately evaluating a price and hopefully a discount that can work. And so when you see distributions coming back, that actually becomes a positive. So that average 30% discount, which you're right, probably is light, but it is the average. When you see that 30 for quality investments dropping down closer to 20, you start to revert back to the mean of the high teens for real estate secondaries. That's when you start to see those LP volumes specifically pick up. And so my expectation is that really through this year and even into next year, you do start to see that LP transaction volume start to pick up accordingly.
And any risk factors that groups should consider? Let's say it's an LP, right, that's looking at their portfolio and they're thinking, okay, well, interest rates, might actually continue to go up. We might see some, energy markets impact as well. But any risk factors that you can note that you say, well, groups should be on the lookout for these factors to really consider whether a secondary sale, whether it's at the asset level or at the LP level, makes sense for them?
Yeah, so I'd say the factors for a secondary sale, again, have less to do with the underlying real estate and more what's happening holistically to them and what's happening within their portfolio. And so all of the factors that you mentioned from a macro standpoint definitely play into that. But if there's a solve from a portfolio construction standpoint, again, meaning there's that over allocation to real estate or over allocation to a sector or too many names, that's where we can solve. And I'd say that's going to happen irrespective of the macro environment oftentimes. And so it becomes less about trying to solve for any one factor.
Yeah, no, it makes sense. Ultimately, their portfolio needs will drive, right, the rationale. Well, just before we get into the lighter part of our chat, is there anything else you want to highlight as you look forward to 2026 that you may be excited about or nervous about, or any of the above?
I mean, we're almost a third of the way through 2026, which is hard to believe as we sit here today. I would say we know we're living in a world of increased volatility, so I don't think we can stay up worrying about that. I think that's just the reality state of play. So for me, it's making sure that we don't leave the stones unturned that we can control. And so for us and for our team, that's making sure that we are diligencing every asset and every facet of every asset so that we can really select not only the themes, meaning the brighter sectors, the geographies, but also the assets specifically that we want to have within our portfolio.
And one thing that, if I may say, in sort of dealing with you guys as a buy-side firm, right, for mostly LP secondaries from my perspective, I'd say you never shy away from an opportunity that maybe not necessarily in sort of the core, or like core is a bad word to use for real estate, but the most, in-demand sectors, if you will, because I think there is lots of sort of risk-adjusted return to be found in an opportunity that maybe is off the beaten path, right? But that has high fundamentals. And, that's at least one thing I've noticed with your team is you guys really take a deep dive into those opportunities as well and try to make something happen if it makes sense for your investors.
We try.
Well, let's get to the lighter part of our chat where we get to know you a bit more personally. Are you ready?
Sure. Let's go.
All right. I'm going to give you a couple of rapid fire questions and feel free to elaborate as much or as little as you want. But what's your favorite book?
Well, two, I guess, maybe come to mind, very different in terms of how they set up. One, Outlive, which I read recently, and I think it's just a good overall, nothing to do with business, but all to do with life and the life choices you make. So I think that's a good one. The other one I would put out there, we actually read as a leadership group called Radical Candor, which if you haven't read it is really focused on how to provide and deliver honest and credible feedback as a group. So whether that can be personal feedback as well as in the business setting, but how can you make everyone improve? How can you lift everyone up? You're going to do that by providing that honest feedback. Don't shy away from the tough conversations, but deliver it right.
I'll take you up on that. I was actually looking for a similar book to read like that. So there you go. Now I know. What is the first thing you do when you get to the office?
We'll probably drink coffee, but I'd say the first thing, but also just make sure I'm prepared for everything in the day, reviewing the calendar, making sure everything is good to go. If there were briefs that needed to be read for meetings or for upcoming deal discussions, making sure we're good to go there.
I sometimes will get to the wrong side of my email box and then I go down a hole for a couple hours and, resurface a couple hours later. So I try not to do that. But what's your most favorite part about your work?
Solving problems, honestly, for not necessarily internally, but externally, thinking about listening to the LPs, listening to the GPs, trying to understand what's the motivation behind the conversation, because we probably have a tool in our toolbox to solve their pain point, but it's really listening and helping that I love.
It's almost like you're putting a puzzle together each and every day.
Exactly. It's funny that you say that too, because as I've described secondaries over the years, it's really you're putting the puzzle together, but there's probably one or two pieces missing. And so it's up to you to find those pieces or sometimes to create those pieces.
Yeah, very true. And are there, lastly, any deals that you're most proud of from your time at Ares?
I would say probably our structured solutions, if thinking about both GP and LP structured solutions, because they're certainly complex. The duration to get those completed is often long, so they become that much more rewarding in terms of completion and the execution of those.
Just given the amount of resources, right, that you dedicate to them throughout the process.
Exactly. And each one is so nuanced in terms of how they would work. So they'll have different levers that we can pull throughout.
Well, that's what I think is exciting about being in, especially the secondaries industries now as it matures, is just you get to be so creative, right? And you're sort of seeing so much more innovation happen out of the industry. And I think probably every guest that I've had on the show has mentioned that, look, we get a chance to work through and find out solutions that didn't exist before. And that's kind of exciting. So.
Agreed.
Well, Michelle, thank you so much for speaking with me today. This has honestly been incredibly insightful, and I'm confident that the audience feels much more optimistic and educated on the fascinating world of real estate secondaries. And thanks for coming on the show.
Great. Well, thank you so much. Really appreciate the time and being invited on.
Once again, guys, this has been Michelle Creed, co-head of Real Estate Secondaries in the Ares Secondaries Group. Thank you for joining us.
Thank you.
And if you've enjoyed our episodes so far, we'd love to hear from you. Who would you like to see next on the show? What topics would you like covered? Send me a PM on LinkedIn or an email, and we'd love to chat. And as always, watch the Secondaries Link LinkedIn page for updates on our next special guest. And we hope to see you in a few weeks where we highlight the next incredible woman on the Women of Secondaries.